420 days, a history record that not many traders or investors like you and I would ever want to see again, has just happened. We'll be talking about that today, along with the big moves on semiconductors over the last 24 hours after we reported huge volume increases. It was BTFD on these markets, but are we actually going into a very key zone? We'll be talking about that along with holding the rally for now. The Q versus SPY combo continues to move up. And are there volume opportunities everywhere? The answer is quite simply yes. There are so many markets with huge momentum moves. And as we move forward, there will be certain charts that we need to keep our eyes on. That and more as we cover stocks, commodities, and cryptos around the world together right now. Well, welcome back everybody to The Daily Show. My name's Tom, and today we're discussing the key macro lead indicators and the hottest charts that you need to be looking at right now. If you love markets like we do, remember to subscribe and smash that like button. So it was BTFD day on Nvidia. As it broke through our resistance level, it continued to squeeze, and there could be a little bit more to come. We'll talk about that later on today's show. But I want to start off with a record that no one wants to see. 420 plus days of inversion of the 2 and 10-year yield curve. Now, if you've been watching the show for a while, you would know that when we're inverted, that's not actually when you need to be terrified. It's when you uninvert that you should be worried. And we've just hit a new record, which previously caused a stagflationary period, which again, we may be going into. And we're actually going to talk deep dive into this moving forward about what asset classes tend to do well and also whether this is a real potential. But one thing's for sure, it's usually very, very good to have these on your charts. 2, 10, and 3-month 10 are some of the best to have. And we will be looking at when they uninvert because, of course, the steepness of the curve, that is how fast central banks cut, will tell you whether the system is incredibly broken or not. If central banks continuously cut very, very quickly, we know that something is completely busted and it's probably going to cause a horrible, horrible time in the markets. If they cut more orderly, then so far they've been managing to weave the circus. And they don't really have a great track record with this, obviously from 1999 periods and also the GFC style periods. So remember, uninversion, that's when you need to be terrified of the charts. Let's talk about CPI. A lot of people are left scratching their heads and they've probably been saying, I tried to short the market and it went up. Why is that? Well, I've got one simple word. It's probably OPEX and the trillions of dollars of options expiration this week. 5,200. So this level here for the S&P, obviously a key resistance level that the markets are trying to get into. And inflation showed us that everything remains sticky and everything remains problematic realistically for the Fed. Now, interest rates were up, yet the market was up. Food away from home was up, shelter was up, one of the most sticky parts of inflation, and transportation services was up. So pretty much if you were interpreting the books, you would think, well, this is a terrible result, or at least not very good, and the Fed's got more room to work on. And yeah, I think you'd be right. But there are some things we'll show later on today where the market might be playing a little bit of a game with us. What about the S&P 500 trailing fourth quarter? Well, you can see here that for the bulls, they're going to be feeling pretty good because if we are going into a hyper boom, similar to some that we've seen before back in the 20s, obviously back in the 1990s, and then of course during the 2021 huge boom in markets, then there actually could be more room to give. A PE of 25x plus is usually reached during these hyper booms. And of course, we're not quite there yet, with a lot of broad market buying to be done and some opportunity there for the bulls, I think, moving forward. Now, have we seen corrections in these previous periods? The simple answer is yes. Have we seen one yet over the last kind of 6 months of rallying? Absolutely no. No 20 moving average weekly. Now, this is a big thing because, of course, we always usually see mean reversion, and this market has been incredibly aggressive. Remember, the data, we might be having some bull and bear kind of data here, but overall, we're looking for the price action to break through the key zones. And of course, the last 24 hours, 5,100 was not broken below, which means we didn't go into a negative gamma style environment. Now, the Fed is obviously working on many different things in terms of getting rid of all of the excess money and in terms of putting some strain on the system. So far, it's kind of working, kind of not really, with inflation obviously taking control. Now, the reason this is important is, of course, when we start to go sideways in transportation average, that often means that if markets go and have rallies during that time, that they are fake rallies and we need to be paying attention. However, I don't think it's an easy enough read as that. We need to see actual weakness. Some other things that have happened is Goldman Sachs have brought out their sentiment indicator claiming that it is now stretched. Now, I don't think this is anything new to most of us. We've been stretched for a while, and of course, it's becoming similar to the stretching that we had leading into the sell-off after June and July stretching of 2023. There's a lot of metrics saying this, but of course, until the price action plays out, we know that we can't really be super bearish. Gold performance into the first rate cut. Now, we have talked about gold doing very well into the rate cuts of the Fed, and it continues to move usually very aggressively over the Fed cut rating cycle. Now, it didn't do well over the last 24 hours because, of course, yields went up. But we can see here that gold is preeminating or starting off earlier, and you've got this compared to other rate cycling periods. Now, this is very important, and of course, we will be continuing to cover gold a little bit more on the channel, as I think it's going to be an important 12 months into maybe even 2 years for the shiny metal. And of course, you know, in many ways, Bitcoin could also do benefit from this as well. Nearing record lows, we've talked about gold stocks, which has become a meme versus gold. I'm still pretty bullish on gold stocks, and they did fall over the last 24 hours again because yields went up. Let's now talk Bitcoin for a second here. It looks like there's some activity in the futures market. Now, a lot of this will be hedging, but really you can see the steepness of the slope here becoming pretty extreme. Now, previous steepness levels, of course, you don't know where it's exactly going to boost out, but these are usually where markets are very, very rally-like, and then all of a sudden it just gets rug pulled. And that's something that's happened before. So just be warned, we are in a very aggressive futures open market with everyone on the buy train. Now, over the last 24 hours, we talked about this. It was actually a really weird one because last Thursday, we talked about the idea that semiconductors got sold at the peaks. Then we got huge sell-offs occurring throughout that Friday period. Then we saw the calm before the storm, and we saw them buy back in. Now, it did turn out that Nvidia was a buy, which we kind of suspected, that semiconductors in general, this is the sell from last week, this is the buy. Obviously, you can see the difference in price being quite substantial. And we got a lot of rallies. Now, is it a dead cat bounce? Semiconductors 3x, the S&P 500 as well 3x, and in general, just all of these types of markets showing these dark pool activities. Could it be some kind of dead cat bounce rally? Well, there are some important levels for Nvidia and semiconductors we'll look at very, very soon. But do remember that there are some signs starting to come in that maybe it's a little frothy for now. One of those being this thing. And I think it's pretty funny what Jason's done here. He's done a good job. He's gone through and he's found when Barron's and The Economist both think that the markets are going to be bullish, and then he's extrapolated that out. Now, it's only happened 3 other times, so don't get me wrong. It's not exactly a great read, but funnily enough, it's actually crescendoed after that to new highs, and then we've seen little corrective pullbacks. Now, have we seen the end of a trend? I think this is very important. The answer is quite simply no, we haven't. In fact, in all circumstances, markets have regained into bullishness quite soon after those correction periods. What are some of the signs we might be looking at? We talked about this VIX spread concept. Obviously, the VIX did not go through 16 again, meaning bears cannot be in control of the market. You need to keep watching that, and we'll keep covering that level. And if we get through 5,200 this week, of course, you'll be wanting to look at mid caps and small caps in general. And I think some of the hypergrowth small caps would do quite well if the 5,200 level is breached. Now, a few people have been asking and saying, why is the Almanac data and, of course, the data from Wayne very different? You're saying that maybe sometimes there's weakness in this week, which is obviously election years, and then there's weakness on Wayne's data in the week after. Well, yeah, it just depends which particular time you're looking at. Obviously, with data, if you're looking at election years, usually we should already be selling off. If you're looking at all normal years, generally it's the post-OPEX that's really bad. Remember, next week is actually only a 5 and 17 bull rating. So if we do manage to hold up, then we see price action go negative next week and go through some of those key levels such as 5,100 and 50.50, then yeah, you'll want to be paying attention because, of course, that is a very important level. For the long-term bulls, are you going to remain bullish? Generally, yes, because, of course, we have that 25 and 0 read, which we've been talking about, which is generally reading for the next 12 months. So do we get corrections in all of this previous data? Pretty much, yeah. We always get a nice-ish correction between 5 and 8, but we haven't had it yet. And it's been a while now, and of course, markets have rallied well over that percentage. CTAs remain basically selling off, and they are usually early. So remember, it's pretty normal for markets to rally a little bit higher. After these reads, we've finally seen a bit of a turn in them, and you can see here that CTAs basically have started to top out, and we've seen sells across both the S&P and the NASDAQ as they reduce their position, and that's something that we will continue to be looking for. I'll get some updates on that over the next 24 hours and share it with all of us. Let's now talk the options market because, of course, options is really important. And as you can see here, we've got some walls. Now, 5,100 was the big wall over the last 24 hours, and it was not breached. If it was going to be a big deal. Now it becomes 5,200. For day traders, they're going to be looking around this level, and you're going to be looking at resistance signs for turning points, all sorts of things like that. If 5,200 is breached, though, the extension of the market could get kind of squeezy again, and we may go 5,250 or even 5,300 still. So remember, 5,100 remains one of the most important bear zones, along with 50/50. And at this stage, it looks bullish into 5,100. Let's now move over to what we need to be watching for the rest of the week. Here's Wednesday, if you want to pause it and have a look at that. Here's Thursday. And of course, here's the Friday period. In terms of overall data, there's still more to come. We've got 30-year bond auctions. We've got 10 years that just went through. And then, of course, we also have retail sales, core PPI, and prelim UOM consumer sentiment coming out on Friday. These are all New York times, so make sure to stay clear of some of the data if you are scalping, as it's still going to be quite volatile. What about the rotation? Well, as we can see here, the 5-day rotation remains kind of a mixture of defensives and the big ones back. Semiconductors and technology coming out of nowhere with those big rallies over the last 24 hours. If we have a look at semiconductors, you can see here they were on 3.16%. Technology was 2%, and solar really got beaten down. And I still think there's going to be some very interesting stuff with the solar market moving forward. So we'll look at that chart in a deep dive very, very soon. In terms of options, it was a pretty big day, though still below the overall. And you can see a lot of people went in on the puts. That's actually one of the higher put reads that we've seen in a while. And what that's telling you is people interpreted the CPI number, they went negative. Obviously, no 5,100 is broken through. So the options market didn't really have to do anything. And we end up forcing it higher. So that's pretty much what occurred. And we'll continue to watch the options market very closely, as it is pretty much one of the keys here for positional flow. Here are the unusual moves. You can see there were some big ones, but really it was about semiconductors over the last 24 hours. VIX 16, let's get into the charts, and VIX 16 remains the biggest problem for the bears. No breakthrough there. Remember to have this on your charts and also put the VVIX on there as well. So you want to put VVIX on your charts and maybe VIX 1D. No breakouts across the board. So until that happens, you can't really be sure the bears are in control. When we talk about yields, you can see here the US 2-year yield came back up into this level here. But realistically, at 4.588, it's still not that crazy. And the US 10-year also went up as well. So at the moment, what we're looking at is probably some kind of rally into yields, then maybe a dump somewhere around here. And where if we go to a new high being above that kind of 4.75%, then we're going to really put pressure on the markets. But if I was guessing, this would be the current setup that I would think could be happening on yields. One worth watching, although there's not really a clear trade there, unless we start to see yields drop, which would be treasuries themselves. S&P 500, we can see central banks around the world have been reducing a little bit in recent weeks, so they're certainly not coming with the rally anymore. So that's something we will continue to follow along with. And our bond market index is right in the middle, basically telling us that we have to remain neutral and taking each day by day. In general, the trend is still up and the coil continues the bonds market. It is going to be fierce when this thing breaks out, and we will be on top of it. So subscribe for that because it's going to be a very wild time. Let's now move over to treasuries. Treasuries ended up doing a little bit of, let's call it island reversal. So basically we gapped up, we gapped down, and there was a little bit of selling through the day, very negligible. Technically, we might go down a little bit into treasuries. My 12 to 18 month market is still very, very strong on treasuries though. You can kind of see with that inversion that when we come out, chances are we're going to see a lot of rate cuts. Then treasuries will probably rally a fair bit. And if we've really broken the system, you'll see super aggressive rate cuts, which obviously would be very good for treasuries. Dow Jones Transportation Average remains kind of just sitting in the middle of nowhere, which we know. And home builders ended up seeing a rebound. So again, that's kind of bullish for the market for now. Dollar index, stuck, not doing much. Euro traders would be very happy. We've been talking about the euro strength being a pretty decent little trade here. You can kind of see it's starting to flag up on the smaller time frames, possibly looking for a break of the 109.80 level. And that is pretty much looking like a flag at this stage. So if we break out, then we're probably moving even higher, which is going to put downward pressure on the dollar index. And you might say, how's that possible? Well, again, it's price action based. And we've already seen the euro really hitting up the dollar for quite some time now. It's been over a week of that. Bitcoin remains in the bullish trend, obviously losing 15% the other day makes me a little bit more cautious of this run. I'm going to go with, yeah, the trend's up, but I'm still neutral on it in terms of thinking it's probably sideways to down. I do think there'll be a better price coming in the horizon. There always is with Bitcoin. It always does a flash kind of sell-off. And we need to be aware that, at the moment, there's a lot of movement into, of course, everyone talking about it. But when you crescendo that, often we do see these aggressive pullbacks. For now, though, if you're long hodling it, I've already talked about how I think it's going to become a $4 trillion asset, which is going to extrapolate out to a pretty high price. And we'll talk about that soon on the show. US oil remains holding, but just barely. I mean, it was pretty disappointing. Obviously, energy stocks did okay and held their own, but no breakout. Even though yields went up, we just didn't see any breakout across all the oils, which is something we've been looking at. Copper, this one here, is newly constrained. So it looks like copper here is going to have tighter supplies. That's going to lead into hopefully, well, it's not going to be a good thing, but it's going to lead into copper higher prices. And I think this thing's going for a 395 break, which is going to put, again, some pressure on the markets. We're going to be looking at 4.11. And I like the inverse head and shoulders, and I like this level. So I think a break is possible here for copper, although it's still early days. Tesla traders, you wouldn't have minded the last 24 hours. A new low being formed here, then a little bullish hammer. Now, this is going to mean that if we come out, remember, this is at the moment a gap down, possible gap up. Now, if we do end up getting a gap up, that will be an island reversal with a low steal. That's the kind of thing I like as a day trader. So if I'm a day trader, I'm certainly looking at Tesla very closely here. For now, the trend remains down. I think buyers that like this will be looking for new highs and then putting stops underneath here. Some interesting stuff happening on this trade. And you've got to be very, very careful, obviously. Tesla can move all over the place. But yeah, I think a pretty interesting 24 hours. Now let's move over to the king or queen of stocks at the moment, which is obviously Nvidia. Really strong daily close, kind of suggesting there's a little bit more in it over the next 24 hours. And it broke through that 800 and high. So we talked about this on our X account and on the previous video. We expected BTFD. We certainly got it. And now we're coming into the danger zone. So I probably think there's a little bit more here on Nvidia to the upside, but it is entering into the danger zone. It didn't drop for any non-reason. Obviously, everyone likes to talk about the news and stuff around it. I think it was just someone dumping a huge position in general. And as we approach this kind of 930 to 950 range, we'll be looking for signs of potential weakness. At this point, though, trend is up. Semiconductors across the board also rallying for the market. So you can see here, we've got some nice rallies coming into semis. In fact, it's an island reversal to the upside. So Nvidia preempted the most, but yeah, some stuff both ends here on semis. I think Nvidia is worthwhile watching very, very closely. Apple remains kind of holding this zone. Remember to have your alert for 165. Did we see enough reasons to like Apple yet? Probably not. I'd like to see it wipe the low, go through 168. I've got alerts all over this thing. We'll be updating you when we see more. Now let's move over to PayPal. I thought we'd just put PayPal in here. Sometimes it used to trade a little bit with crypto. Obviously, there are some reasons why it could do that. And this has been a hated stock for a long time. Now, we've talked about PayPal liking this zone. And obviously, I brought it up on the show in January saying this was a bit of a breakout. Now, it continues to hold this level with a lot of wicks. It doesn't look too bad on the weekly charts, and it doesn't look too bad in general. So I'd like to see this kind of pick up. You can see volume here has increased a few times. So if PayPal is going to come through, let's say the Russell breaks, I could see PayPal starting to blow up, and it's an interesting stock there. German market, new high, still squeezing out everyone. We'll update you guys on retail CFD sentiment very, very soon for this one. So something interesting that we'll be looking at. And of course, HSI, which is the Chinese market, continues very, very strong here. So we've got some massive breakouts across the HSI. We've got breakouts across so many Chinese tech stocks as people start to wake up for the AI side of these stocks. Still, probably more room to give on those. So looking quite good. Aussie market holding its own, really just waiting on the US market. Nothing much to report there. And if we go into we've got Square here, which obviously has been a pretty interesting base. But if we go into the US market, you can see here that the NASDAQ remain to hold the areas. 17,800 or 17,780 holds. Still didn't make a new high, which is interesting. So obviously it's weaker than the S&P across the board. And it could still be that we break down. We haven't done it yet though, so it's too early to tell. US 2K remained a little bit negative, I think. So 2000 will be the kind of bigger buy area. We've already talked about this being a topping point, 2090, 2120 being a huge bull breakout. I'm excited for that in the future, but not yet. So that's kind of where we're looking at it. Now let's move over to the S&P 500, and you can see here if we go to the S&P 500, which will load right now, then we're still getting 50-50, 51 or 50-95, 5100 will be a huge gamma switch. A lot of money at stake. Obviously, options max pain is technically more down at this level. We don't have to hit max pain, but if you're going to hit it, generally it's in OPEX weeks. And I just think there's a lot of money at stake. So 5200 remains the key resistance level for this market. So watch that one. We're starting to slow down as in we're melting up here. And 5100 or 5095 and 5050 remain the key levels to be actually seeing any kind of bearish action. For now, the trend has been generally bullish. So of course, the markets are still bullish at this stage. It's too early to tell anything else. If you enjoyed today's video, then remember to subscribe and smash that like button. And we'll see you in the next one with a whole bunch of new data coming out very, very soon.